Module 2. Identifying blue-chip stocks. Identifying blue-chip stocks using fundamental analysis involves assessing various financial and qualitative factors to determine the strength, stability, and growth potential of a company. Here are key steps to help you in the process: company size and market capitalization. Blue-chip stocks are typically large-cap companies with substantial market capitalizations. Look for companies with market capitalizations in the billions or even trillions of dollars. Financial strength and stability, revenue and earnings. Evaluate the company's revenue growth and earnings stability over the long term. Look for consistent revenue growth and a history of strong earnings. Cash flow. Assess the company's ability to generate consistent cash flows. Positive and increasing cash flows are indicative of a stable and healthy business. Balance sheet. Examine the company's financial position, including its debt levels, assets, and liabilities. A healthy balance sheet with manageable debt and strong asset values is favorable. Profitability and growth metrics. Return on equity, ROE. ROE measures a company's profitability by comparing its net income to shareholders' equity. Look for a consistently high and improving ROE. Earnings per share, EPS. Evaluate the company's EPS growth over time. Increasing EPS is a positive sign of profitability and potential future growth. Sales growth. Assess the company's revenue growth rates, both historical and projected. Look for steady or increasing sales growth, indicating a strong market presence. Dividend history and sustainability. Dividend payments. Check the company's dividend payment history, including the consistency and growth of dividends over time. Dividend payout ratio. Evaluate the ratio of dividends paid to the company's earnings. A sustainable dividend payout ratio indicates that the company has sufficient earnings to support dividend payments. Competitive advantage and market position. Industry position. Assess the company's market share within its industry and its ability to maintain or expand its position. Look for companies with a competitive edge, strong brand recognition, and barriers to entry. Moat and competitive advantage. Identify factors that give the company a sustainable competitive advantage, such as intellectual property, economies of scale, or strong customer relationships. Management and corporate governance. Leadership team. Evaluate the management team's track record, experience, and ability to execute strategic initiatives. Corporate governance. Assess the company's governance practices, including transparency, accountability, and adherence to ethical standards. Industry and market analysis. Industry trends. Evaluate the growth prospects of the industry in which the company operates. Look for sectors with strong long-term growth potential. Economic factors. Consider macroeconomic factors that can impact the company's performance, such as interest rates, consumer spending, and regulatory changes. Remember, fundamental analysis is an ongoing process that requires continuous monitoring and research. It's essential to analyze both quantitative and qualitative factors to make informed investment decisions when identifying blue-chip stocks. Additionally, diversification across different blue-chip stocks and sectors can help mitigate risks and maximize potential returns. When identifying blue-chip stocks, several criteria play a crucial role in assessing the company's strength, growth potential, and market leadership. Here are key factors to consider: strong financials, revenue growth. Look for companies with a consistent track record of revenue growth over the long term. This demonstrates the ability to generate increasing sales. Profitability. Assess the company's profitability ratios such as gross profit margin, operating profit margin, and net profit margin. Look for consistent or improving margins. Debt levels. Evaluate the company's debt-to-equity ratio and interest coverage ratio. A lower debt-to-equity ratio indicates lower financial risk, while a healthy interest coverage ratio signifies the company's ability to meet interest obligations. Consistent earnings growth. Earnings per share, EPS, growth. Analyze the company's EPS growth over time. Look for a consistent upward trend in earnings, indicating sustainable growth. Return on equity, ROE. Consider the company's ROE, which measures its ability to generate profits from shareholders' equity. Look for a high and improving ROE. Competitive advantages, brand strength. Assess the company's brand recognition, reputation, and customer loyalty. Strong brands often command pricing power and customer preference. Intellectual property. Companies with patents, copyrights, or other intellectual property rights can have a competitive edge, protecting their market position. Economies of scale. evaluate if the company benefits from cost advantages due to its size and scale of operations. Making it difficult for competitors to replicate. Industry leadership, market share. Identify companies that have a significant market share within their respective industries. Higher market share often implies a competitive advantage and industry leadership. Innovation and research development. R&D companies investing in R&D and constantly innovating are more likely to stay ahead of competitors and maintain market leadership. Regulatory environment. Consider the company's ability to navigate industry-specific regulations effectively. As compliance and regulatory expertise can be a competitive advantage, it's important to note that these criteria should be considered in conjunction with each other and with a long-term perspective. Blue-chip stocks are expected to have a proven track record of financial stability, consistent earnings growth, sustainable competitive advantages, and industry leadership. Conducting thorough research and analysis of these factors will help you identify companies with strong fundamentals and potential for long-term success in the blue-chip category. Qualitative factors are essential when evaluating blue-chip stocks as they provide insights into the intangible aspects of a company's operations, culture, and overall competitive advantage. Here's the importance of qualitative factors: brand recognition and reputation, competitive edge. A strong and well-known brand can provide a competitive edge by fostering customer loyalty, increasing market share, and allowing for premium pricing. Perceived quality. A reputable brand is often associated with quality, reliability, and trustworthiness. This perception can lead to increased customer demand and market acceptance of products or services. Market position and industry leadership. Competitive advantage. A company's market position and industry leadership indicate its ability to outperform competitors. It suggests that the company has unique strengths, resources, or strategies that set it apart. Pricing power. A company with a strong market position may have the ability to dictate prices and withstand price competition more effectively. This can contribute to higher profit margins and financial performance. Management quality. Strategic vision and execution. Effective management teams demonstrate a clear strategic vision for the company's future growth and success. They can translate this vision into actionable plans and execute them effectively. Experience and track record. Experienced and competent management teams bring expertise, industry knowledge, and a proven track record of making sound business decisions. Corporate culture. A strong corporate culture that promotes integrity, innovation, and a customer-centric approach can positively impact a company's performance and long-term sustainability. Innovation and adaptability. Ability to anticipate and adapt. Companies that foster a culture of innovation and adaptability are better equipped to identify and capitalize on emerging trends and changing market dynamics. Long-term growth potential. A company's ability to innovate and introduce new products or services can be a significant driver of long-term growth, helping it stay ahead of the competition. Risk management and governance. Risk mitigation. Qualitative factors, such as effective risk management practices, can reduce the potential impact of external risks and improve a company's ability to navigate challenges. Transparent governance. Companies with transparent governance practices and strong ethical standards instill confidence in investors and stakeholders. While qualitative factors are more subjective than quantitative measures, they play a critical role in assessing a company's overall strength, competitive advantage, and future prospects. Evaluating brand recognition, market position, management quality, and other qualitative factors helps investors gain a deeper understanding of the company beyond financial metrics, contributing to informed investment decisions.